Hello everybody, my name is Saul Miller and I'm one of the portfolio managers for the Ned Group Balanced Fund. This is the performance of the fund going back to inception, and you can see here we compare it against our own internal benchmark of CPI plus 4, and we also compare it to the ASISA average, and you can see the fund has done well relative to both of those metrics over time. Here you can just see it across different time periods relative to the ASISA sector average, and you can see the fund has done well on all periods. Another important point just to mention, in addition to good returns, is obviously the volatility of the fund or the riskiness of the fund. And what you see here is despite the good returns, we've managed to keep the volatility below the median fund. And that really talks to our focus on protecting against downside returns in the fund. That's one of the key important things that we really look for when we look for investment opportunities in the balanced fund. I'm going to move on to what did well and what did badly for us over the last year. Before I do, just to point to a few key themes that we've seen in markets over the last year. First of all, as you well know, global markets have been under pressure and the SA economy has been under pressure, and we've obviously seen that in a much weaker rand. So it's not surprising that foreign bond holdings and foreign currency holdings in the fund have obviously contributed nicely to performance. Some of our offshore exposed counters, like the likes of Bidcorp and Anheuser-Busch, have also done well. They've actually done well in hard currency as well. We've had a reopening of China, which has been good for Chinese shares, hence not surprising to see Naspers and Prosus doing well and contributing to returns. The key disappointment for us would have been Sasol, and that's not so much even the underperforming oil price of late. It's more really due to specific issues around Sasol and production issues in the company, which have really been disappointing. And then in addition to that, we've obviously seen the PGM basket being under pressure, and that's obviously brought pressure on platinum miners. With that, I'm going to move on to what we think are some of the key themes impacting the world over the next year, and this will hopefully give you a sense of how we have positioned the fund. So first of all, we think the US markets are still overvalued. We are worried about a recession hitting US markets in the next 6 months. We haven't yet seen the pressure from very high interest rates or the rapid increase in rates over the last year. We still think you will feel that pressure in the short term. In addition to that, we've obviously finally had China reopening, so it's not surprising that we've seen a lot of shares exposed to Chinese consumption benefiting quite strongly. And then finally, the SA economy seems to have gone from bad to worse, and really in particular, we're talking about load shedding that everyone is well aware of. The one positive for SA is that at least valuations are close to historically low levels. So let's start with the US. If you look at the slide here, I'm showing unemployment against recessionary periods. And what you can see is from the massive COVID stimulus that we had, or post-COVID stimulus that we had a strong economic expansion in the US, and that really shows up in this record low unemployment. At least it's the lowest it's been in the last 50 years. So we haven't yet seen the pressure on the economy from the dramatic increases in interest rates that we've had over the last year, but we certainly think you will ultimately see that. It takes time. It takes sort of 6 to 9 months until you see the impact on credit demand, which eventually feeds through into the economy. Usually from these low levels, once unemployment starts ticking up, it continues ticking up, and that has always resulted in a recession historically. And recessions are generally associated with underperformance in US markets, in particular the S&P. If we look here at earnings expectations, they are still at fairly high levels, which is not unsurprising. The economy is still doing reasonably well. Although we're seeing some signs of a slowing, it still is quite buoyant, so it's not surprising to see margins on the S&P at very high levels. But what we see, which is a bit worrying, are expectations for earnings growth are still quite elevated. So we're expecting a lot of earnings growth, or the market is expecting a lot of earnings growth from fairly inflated levels of earnings currently, and that is obviously a risk to us. If you do go into recession, you can easily see earnings going down by about 20%. That would then put the S&P PE at a fairly extended level of over 20, which we think is incredibly expensive and is certainly a worry for us. Over here, what I've done is I've overlaid bank lending standards, or the percentage of banks that are tightening lending standards, and the axis is in reverse. So as the dark green line comes down, that means that lending standards are becoming tighter. I've overlaid that against S&P earnings led by 6 months. And what you can see here is that lending standards, although they're not as tight as they were during the recession or during COVID, they are certainly very tight. And given where they are, you would certainly expect the light green line to continue going down, which is earnings, and would pretty much suggest that you would have negative earnings growth from here. So this just really adds to our worry about pressure on the S&P, and it really talks to why we have quite a sizable hedge on the S&P 500 index in the portfolio. Moving on to China. We've seen the reopening finally taking shape, and we're seeing the benefit coming through in various consumer metrics in China. I'm just showing you one slide here which really looks at international travel, and you can see it's picked up quite aggressively over the last couple of months, but it's still way below where it was pre-COVID. So it's not surprising that we're seeing shares that are exposed to Chinese consumption doing well, whether it's the likes of Richemont in the luxury sector, or whether it's the likes of a Tencent that's had a reasonable recovery as well. The other positive that we're seeing is, for now, we are seeing a bit of an easing on regulatory pressures in China. I mean, one of the examples of that is we're finally seeing gaming approvals for companies like Tencent. This obviously still remains a risk. We can't forget some of the draconian measures that the government undertook over the last few years, but at least for now, things seem to be a bit calmer on that front. If we look at what we expect the Chinese government, or if we look at the stimulus that we expect to see, given that they're coming out of a downturn, it'll probably be less beneficial for fixed investment and hence commodities than it's been historically. The government wants to drive more of this upturn, or this economic upturn, via consumption rather than reinflating the property bubble, which obviously has all its associated ills that the government would want to avoid. And given that we're not seeing that level of expenditure in fixed assets, we're obviously not seeing the same pull through to commodities, and that weighs a little bit on the rand and probably talks a little bit as to why the rand has been weak. Although the main reason why the rand has been weak is obviously due to our own goals, and in particular we'd be talking about load shedding that just seems to have gone from bad to worse. So if we are lucky, hopefully next year we will see some kind of improvement as we see the private sector investing more in the provision of power. But this year it's looking pretty tough. I think we're going to be in for a rough winter. In addition to that, as you can see from the pictures, we also know that infrastructure has been under threat in SA. It's obviously far worse in some provinces compared to other provinces, but it certainly weighs on economic growth. We've got higher rates as well, so rates have gone up a bit higher than we expected. That puts more pressure on the consumer. And our macros are looking a little bit poor. We expect a lower tax rate, a lower tax take, which is obviously bad for the budget. We may well have a higher budget deficit than expected. And this obviously isn't good for bonds, and it's not good for currency either. The silver lining, if you could call it that, is the fact that valuations are at least at fairly low levels. They're low by historic standards. What we've done is we've certainly using a margin of safety when it comes to investing in SA shares to allow for the tough environment, and we've tried to position ourselves in sectors that will be less affected by load shedding. Hence, we've been a bit more exposed to financials than, let's say, retailers. If you look at how the portfolio is structured currently, you can see equity or net equity exposure is reasonably low at about 57%, and we're achieving quite a bit of that low exposure via our foreign hedge, which is a hedge on the S&P 500. There's a reasonable exposure to offshore shares that are listed on the JSE, like BTI and Anheuser. We have a reasonable exposure to the mining and resource sector, but we've tried to avoid, or at least limit, our exposure to commodities that are very dependent on Chinese demand, like iron ore. So we've preferred our exposure to be via miners that are more exposed to the base metals, like Glencore. And then you can see our domestic exposure, and as I mentioned earlier, we've preferred to take it via financials than some of the other sectors. We think they will be a bit more defensive against load shedding. And then finally, there's a reasonable holding in bonds. You're obviously getting fantastic real returns on bonds at this stage. Given the tough macros we're seeing in SA, we're not expecting any capital gains in the short term, but we think you will be able to at least earn that high yield that you're currently getting on bonds. Thank you very much. So the kind of conditions we would want to see before we increase our offshore allocation is we really want to see the S&P 500 come under a bit more pressure. We think it's very expensive. It's obviously by far the largest contributor to global markets, and it's obviously, given that we're worried about the valuation of the S&P, that's why we have such a sizable hedge on it in our portfolio. But essentially, the S&P 500 at these levels is not discounting much of a recession at all. It's on fairly high levels, and expectations for earnings are still incredibly elevated. They're basically expecting, the market is expecting earnings to grow off already high record margins, which we think is a bit unrealistic. So we want to see that discounted into the market, or at least we want to see an expectation of a recession being discounted into the market, and hence we want to see the market fall. And we want to see valuations reach more reasonable levels before we up our exposure, or at least before we take that S&P 500 hedge off. We may well need to be in a recession before we see that, before we see the market actually selling off, or there might be some negative data points that bring the market down. But at this stage, we'd say optimism is still at fairly high levels in terms of the valuation of the S&P 500. We do have a reasonable allocation to financials compared to some of the other domestically exposed sectors like retail. It's not because we're hugely bullish on financials. We just think they will be more defensive in terms of their earnings relative to some of the other sectors. We just think they are better positioned when it comes to the impact of load shedding. You don't have freezers that you need to keep open or shopping center lights that you need to keep open. So it is easier for them to defend against load shedding pressure. But they also can certainly come under pressure. We know that financials tend to be a bit of a lightning rod for conditions in South Africa. So if things do worsen, they certainly could come under some pressure. But what we like about them are the valuations. And when I say valuations in particular, the dividend yields are particularly generous for many of the financials. So a lot of your return that you're getting, or your total return, is actually coming in the form of a dividend as opposed to expected future growth. And we like that, just given the uncertainty concerning the SA environment. And hence, that's why we have a larger exposure to financials at this stage. Let me start by saying that the mismatching of assets and liabilities that we saw at some fairly well-regarded banks in the States recently is certainly something we never would have expected. It's the kind of thing you would know even if you had done Risk Management 101, not to mismatch your assets and liabilities to the extent that they did. So that was quite surprising to us. Will there be other accidents that we see going forward? There certainly may be. We've obviously been in an unusual period over the last decade of very lax monetary policy, incredibly low interest rates. In some instances, we've had negative interest rates, so you're almost being paid to take on debt. That obviously creates some perverse incentives. You will essentially invest in projects that in normal circumstances would be uneconomic. So as you get rates rising up and some of these projects need to be refinanced, of course you can have a huge amount of pressure. Where that happens in the economy isn't clear, but clearly sectors that are highly dependent on financing, like property or like private equity, if we have rates continuing to go up, you wouldn't be surprised to see those sectors coming under huge pressures. So that would obviously be one of our worries. We don't think rates will continue rising or necessarily rising from these fairly high levels. As I said earlier, we do think the likelihood of a recession or a significant slowdown is likely. And hence, we'd probably expect rates to actually come down from these levels. And that obviously brings with it its own issues, because they'll be coming down because we'll be going into a recession. So that also wouldn't be positive. But yes, a continued rise in rates from here would certainly place a lot of pressure for businesses and for consumers. And we would definitely see some huge hiccups in the global economy if that was to occur. It's not the only risk that we worry about. There are other risks. There are geopolitical risks, which we haven't really seen up until the last couple of years, where we have two superpowers that are going head to head. That obviously brings with it huge market risks. We're seeing the rise of AI. That's also becoming a huge risk in terms of its impacts on the economy. They still are very uncertain and are yet to be determined, but that could certainly have some major changes for markets, which is also something that we worry about at this stage.